Continuing with the SaaS growth course. I'm here in downtown Austin, Texas still, and loving it. Our new home. Now let's jump into lesson 17, all about raising angel capital and seed capital. Let's full screen this presentation and jump right in. So in this presentation, we're going to be talking about raising a seed round, raising an angel round. Now, I only recommend doing this after you've got customers, product market fit, at least 100,000 in ARR, ideally more. And let me start with a story. So back in 2006, we were in our third or fourth year of building iContact. I was 22 at the time. I'm the guy on the right side, a little bit larger back then. And we needed some growth capital, or shall I say we wanted some growth capital, because we had figured out our unit economics. And if you remember from the earlier lesson on SaaS unit economics and figuring out how to build a profitable growth engine using profitable advertising to scale up, we had figured that out. We knew our unit economics were $500 to get a customer to generate $2,000 of lifetime value. And we wanted to put more money into Google Ads to scale up. And so we went out, raised $500,000 from NC Idea in Raleigh, North Carolina. And this was the celebration party. You can see our CFO right behind me. He was good at giving me the credit, but really he was the experienced guy in the room who really helped us grow. Now I'm 40. Now I'm in Tim Oakley's role, not as a CFO like he was, but as a senior advisor to many fast-growing software companies. Back in that round, we raised $500,000 after we had bootstrapped to 1 million in ARR. And that's important, and that's something I recommend. Capital efficiency is key, and raising less than 1 times your ARR is key. That's why I say don't raise angel, don't raise a seed round for R&D. Do whatever you can to get your R&D done through either pre-selling, crowdfunding, maybe convertible notes from friends and family, but I ideally stay away from institutional capital until you've got a couple million in ARR. Here, we set the valuation of this round based on a formula, and NC Idea and us decided to agree on 4 times revenue for the next 12 months was going to be the valuation, and we did that because we couldn't agree. They knew they wanted to do the deal. They wanted to invest in us. We wanted to take their capital so we could grow, but we thought we were worth 10 million, and they thought we were worth 6 million. And we said, well, we're not going to take that. And so they said, you know what we'll do? We'll take a formula. We'll apply 4 times whatever you actually achieve in revenue in the next 12 months. That'll be your valuation. And we said, great, let's do it. At the time, we were doing $1 million in annual recurring revenue. Now, in the next 12 months, we did $4 million in annual revenue by investing and plowing their capital into customer acquisition through sales and marketing. And we ended up only having to sell about 3.5%, 4% of the company. Now, this investor did well. They made 10 times their money when we later sold the company in 2012 for $170 million. And this was the timing and amount of all of our various fundraisers. You can see the $5,000 loan we took from a friend at Christmas 2003 when our server died and we needed a quick capital injection. We later paid him back and gave him some equity. So he did very well. In 2006, we raised that $500,000 from Idea Fund Partners at the $16 million pre-money valuation. Everyone did well there. And in 2007, we raised $5 million from Updata Partners when we had about $5 million in ARR. So again, less than 1x ARR is what we raised. That was our Series A, or Series A1 here, because a year later we did another $2 million tranche at the same valuation that we had pre-agreed to. And then in August 2010, we hired Allen & Company from an investment bank from New York, and they helped us raise the $40 million round from JMI Equity when we had about 40 million in ARR. So again, less than 1x ARR is what we raised, capital efficiency. And that was at a $100 million pre-money valuation, $125 million post-money valuation. And then about a year and a half later, they turned their investment from about 40 million into actually we're 79 million. They did quite well as well when we sold the company for 170 million. And in total, you can see here we raised $32.5 million to generate 50 million in ARR. So good capital efficiency. And if you've been watching these videos, you might know that in August 2010, when we closed on that round from JMI Equity, we raised 25 million to the balance sheet, which went to the company. But we also raised 15 million in liquidity So if you add 169 million plus the 15 million that we had earlier sold, we ended up netting out about $184 million in shareholder liquidity, either through the fundraising liquidity or the eventual liquidity. And I did pretty well from that. My business partner and I did very well, and it provided an amount of wealth that assured me that I would only have to work on things that I really love to do. And today what I really love to do is help SaaS companies scale and grow and advise them on their exits and their fundraisers. And I love this type of work and building educational courses like this that help SaaS companies scale up. So I learned those lessons, but then I didn't apply those lessons in my next company. I was 28. I was building a company called Connect.com. We had successfully built iContact for 10 years in the B2B space, and we decided to build a B2C startup, a business to consumer startup on mobile. And I moved to Silicon Valley, to San Francisco, raised over $10 million for this company, Connect.com. Over $6 million of that was my own money. And we decided to go for eyeballs. We decided to have a strategy of get as many users as possible and then figure out the business model. And I don't know if you'll get this reference, but if you're American, you might. There's a famous episode of South Park where there's 3 steps to building a business. Step 1, steal the underpants. Step 2, ? And step 3, profit. That was pretty much our business model at Connect.com, if you get this reference. And we did not know how we were going to make money. We just spent a lot of money on building a beautiful mobile application to compete with Facebook, but have it on a map. And then we got 4 million monthly active users, we raised a Series A, but we could never figure out how to monetize it. And then in 2015, when Facebook changed their API because of Cambridge Analytica, we lost access to a lot of our data. And we ended up not being able to build a successful company, and we shut down in 2016. And then went back to business school, finished my second year at MBA program at HBS. And since then, I've been focusing on helping SaaS companies scale up. And so what did I learn here? I learned to focus on, number 1, building a business model, and number 2, getting customers before you raise outside capital. I repeat, get customers before you raise outside capital. Get product market fit before you raise outside capital. And that will maximize your chance of success. Don't do what we did at Connect.com. So keep costs low. Survival is key. Do whatever it takes in the beginning to keep your costs low. Bootstrapping is where it's at. Get as far as you can without raising outside capital. And instead of spending 6 months raising outside money, focus on getting revenue from customers. Be a salesperson for revenue, not a salesperson for capital, for equity capital. And do that by pre-selling what you're going to be offering to them. Or if you're going to go out and get capital, go do something like crowdfunding on Republic or Start Engine, where you're getting 100,000 or 200,000, just enough to get the R&D done. If you need upfront cash to create your product, you can have your customers fund your product by pre-selling. Get money from customers, not from investors, and you'll save yourself a lot of headache and a lot of dilution. You'll have a much higher chance of success and lower dilution if you get paying customers before raising outside dollars. Wait to raise your Series A round, your institutional capital round, until you have a proven mathematical growth engine that X dollars in brings Y dollars out. That is what we talk about and what we preach here at SaasRise. The biggest mistake entrepreneurs make is raising too much money before they are ready. So don't do that. Do what we did at iContact. Bootstrap for the first few years, get to $1 million or $2 million in ARR, and then raise growth capital if you want. iContact took no money in the first 3 years to get to that 1.5 million in ARR. We pulled ourselves up by our own bootstraps. It's a reference from the Old West. Do whatever it takes. I remember living in the office the summer of 2003, jumping in trash dumpsters to get proof of purchase tags off of cardboard boxes to return the $50 rebates at Staples. I literally jumped in a dumpster to get a $50 rebate. I wouldn't do that today, but I did do that at 19 when we were getting started. Do whatever it takes in the beginning years. Now, if you're a SaasRise member, you're past $1 million in ARR, most likely. You're probably at 3, 5, 10, 20 million in ARR, so you're past this phase. But if you're watching this and you're not yet at $1 million in ARR, focus all of your energy on getting to $1 million in ARR first through founder-led sales, founder-led marketing, and founder-led development if you need to. We deferred our salaries, as I've mentioned, for 3 years, and we built websites for others on the side to pay our personal expenses. So think about bootstrapping before you raise outside capital. Don't fall into the ego trap of raising money at a high valuation that might get you the press release to make you look good in front of your beloved or your girlfriend or your spouse, but it's not going to get you to actually succeed, because if you're putting money into a broken engine, you're not going to go anywhere. So when to raise, get to at least 100,000 in sales before you even consider raising seed capital or angel capital, ideally $1 million in my book. Raise after you get to product market fit, after you have customers paying. Customers are the key. That's something we could never figure out how to get to at Connect.com, but obviously we had 70,000 paying customers at iContact, the company that worked. So if your current ARR is less than 100K, just focus on increasing sales, not raising capital. Build your product, increase sales. Use the first half of this course to implement the growth tactics that we talk about, like B2B outbound prospecting, paid ads that actually are profitable, and then raise capital once you have your system. So where do you raise from? Well, that'll depend on how much you need and how far along you are. You can use this chart to figure out where to raise from. If you need less than 50K, well, you can get that from side jobs, credit cards, savings, friends and family, Kickstarter, Indiegogo, Fundable, and many other places that allow you to raise crowdfunding. If you need between 50 and 100K, you can also get that on Republic or Start Engine. 500K to $1 million, you can get that from angel investors, from FounderPath, which provides revenue-based financing like we spoke about in the last lesson. And then depending on how much you need, you might have to go to seed stage venture capital, growth stage venture capital, later stage VC. And then once you're needing over 25 million, you can get into private equity, and that's where it really gets fun. So the stages of fundraising events, tend to be based on how much you need and how far along you are. So you can use this chart to give you a sense as to when to raise the amounts from various sources. Now, keep in mind that once you're on the venture treadmill, it's hard to get off the venture treadmill. You need to keep raising more and more money at higher valuations until you either sell the company or go public. And it is a little bit like a high stakes poker game where you have to keep doubling down in order to end up succeeding. And keep in mind that 99% of companies don't raise venture capital, and probably about 95% of software companies do not raise venture capital. It's not necessary, but if you do it, you want to do it right. And that's why we put together this deck on this topic, so you can decide thoughtfully about whether to raise angel and venture capital. So as a rule of thumb, to minimize dilution and loss of control, never raise more than 1x your current ARR. If your current ARR is too low, just focus on getting money from customers via sales, not investors. Successful firms rarely raise more than 1 times ARR. You can see here in this benchmark from Benchmark Capital, actually I believe this is from Bessemer Capital. You can see here that the most successful companies have about anywhere from 0.5 to 1x their ARR is how much they raised. That's their cash conversion score. You want yours to be at least 1. Now, angel capital is appropriate for high growth firms seeking to raise between 100K and 2 million. Sometimes these are called seed rounds. We're going to show you in the next few slides how to raise an angel round and how to raise a seed round. Right? Here's a description of what are some of the key milestones for when to raise. You can take a look through these slides because there's a lot of content in here on your own time. But what I want to get to in the next couple of slides is I want to get to how to raise this capital. So let's talk about how to find angels. So if you're building a high growth tech company and you've already got some product market fit and some revenue, here's how to find angels. So you can use LeadLoft and you can use FounderSuite. Let's take a look at their interfaces. FounderSuite is probably the best platform for not only having investor contacts, but being able to manage and track your reach outs as well as your commitments, and having a data room and actually sending out these emails to these investors. I highly recommend it. It really organizes everything. And you're going to want to use it. You could also use Apollo.io or Instantly or LinkedIn Sales Navigator, but I think this is a great centralized source of great investor contact data, and it's really not that expensive. So we like using FounderSuite. Whenever we do a round, we encourage both FounderSuite and LeadLoft. They're great tools. You want to when you're raising a round, you sort of are like an account executive or even like an SDR. You can even hire an SDR to help you with raising a round. LeadLoft matches investors to the opportunity. It implements an automated outreach funnel for you based on your targets, and then you meet with investors and raise capital. So that's how LeadLoft works. It's a good service, and it also allows you to purchase a list of active angel investors with up-to-date data. You can also do equity crowdfunding on platforms like Republic, Start Engine, Fundable, WeFunder. I've used Republic before, and we raised about $200,000 from Republic members in 2020, right before COVID happened. And these are places where you can go raise $100,000 to $500,000 in early stage capital for your company from hundreds of investors. Start Engine also is a similar competitor to Republic that allows early stage companies to raise money. And WeFunder also, and Fundable is the fourth platform. Check them out. Crowdcube also is another good place to be able to do crowdfunding. So angels, they tend to act like a herd. So if you know them personally, great. But if you don't know them personally yet, you really want to work first on securing a lead investor who will agree to the terms that you have or set the terms before reaching out too wide. So focus on first finding your lead investor who will put in 25%, 50% of the capital for the round, and then syndicate it. You'll get other investors and you can ask them for referrals to other people they like to work with. So top angels have packs of other angels who follow them and invest in what they invest in. These are called angel syndicates. Now let's talk about convertible notes and SAFEs. Many startups raise angel capital using either what's called a convertible note, which is essentially a loan that converts into equity, or a simple agreement for future equity, a SAFE, which is just sort of a type of upgraded convertible note 2.0. Convertible note is a loan that converts into equity at your next raise, usually at a set valuation or at a discount to the future equity price. And most angel deals in Silicon Valley are now done as convertible notes or SAFEs and not priced equity rounds. Whereas most venture deals, the difference being is they actually price the round at a certain valuation. And so that allows you to get these done. Instead of raising at a valuation that you have to decide on in advance, you raise it at a maximum valuation. Or you could structure it to be at a minimum valuation if you want, if you have good leverage in your negotiating. What I would do when I raised a SAFE a few years ago, or it was actually a convertible note, is we set the valuation to convert automatically 24 months later at $10 million valuation or at a 20% discount to the next round, whatever was the higher valuation. So we had good leverage because I'm an experienced entrepreneur who's exited before. Whereas just if you have similar leverage, you can get those terms. But if you're a first timer or second timer, maybe you might have to do whichever's lower. So the key terms of a convertible note: the amount invested, the discount rate, the valuation cap, that's the max valuation that it will convert at, the pro rata rights, and the interest rate, the amount of money that the convertible note increases by each year. The discount rate is the discount amount to the next round. It's almost always 20%, but it can be negotiated. So what is a SAFE? It's a simple agreement for future equity, as we mentioned. And here's how these two things work. We've already talked about this, but just some of the key terms is the interest rates on convertible notes and SAFEs are usually about 4 to 8%. The discount's usually 20%, as we mentioned, and then the cap is often between 5 and 15 million. Depending on how many engineers you have, how much revenue you have, how much traction you have. Now, the SAFEs were created by Y Combinator around 2014, 2015, and they're an alternative to convertible notes, but it doesn't have a maturity, it doesn't bear interest, so it doesn't therefore have an interest rate, and it basically makes it a cash investment in the company that converts into stock in the next round of financing at a discount or a capped valuation. So it's simple to do, and you can get a lawyer to draft up this or use an online template and work with investors. I do recommend using a lawyer for any equity round or any convertible note or SAFE round. Now, once you've found your investors, you're going to need a deck to send them. So you need to create a deck before you start reaching out with LeadLoft, and you could put it behind DocSend or reaching out via FounderSuite. And here are the basic things you want to have in your 10 to 20 slide pitch deck: problem, solution, product, technology, traction, market competition, team, revenue model, and financial projections. And I promise you, if you can show 500,000 in ARR or $1 million in ARR already, you're going to get a lot higher response rates and a lot more interest in investing. You can find slide deck templates on SlidesGo or just Google, startup pitch deck examples. You can see some examples that we have here and some more examples here. So use these resources to create your deck if you want. All right, and then utilize these winning deck examples. This is from SoFi's, I believe it was Series C, and Arrival Series D. You can see their actual investor presentations. Invest in design. Go use Pickle or Design Pickle or Superside, and or even Upwork, and just spend $500 to get your deck really designed. Imagine, it's amazing how much time founders will put into fundraising, but then they won't spend $500 or $300 even on getting their deck designed. Don't make that mistake. So in the first 3 slides of your deck, clearly illustrate the problem you're solving and how you're solving it and for whom, who's your target market. Show pictures of a prototype or your actual product, and share your product roadmap, key milestones toward your product delivery, and talk about future features, products, and services you want to offer. And then in your financial forecast, which you don't leave that out. A lot of companies leave that out, but I think it's important to include your financial forecast, including revenue and expenses and net income and cash balance by month. You can have just a simple graph here, like this example that shows the low point of aggregate net loss. You can build this in Excel in half an hour, and show how much you're going to need to raise over time to get to cash flow positive, and be conservative. Don't project 100 million in revenue in year 3. It's just not going to happen. It's going to take you 9 years to get to 100 million in revenue, even if you're extremely successful. So don't create the bullshit meter. Don't make the bullshit meter go off by projecting 50 million in year 2. Most likely, if you're successful, you're going to get to 1 million in revenue in year 2. And maybe by year 5, you'll get to 30 or 40 million if things are working. So here's an example, basic financial projection of a company that goes from 18,000 in 2027 to 4 million in 2031. And you can see here in 2030, when they had 1.8 million in revenue, they, in this made-up example, raised $3 million. So answer these questions in your deck. What problem are you solving? Why are you and your team passionate about solving that problem? Who's on your team? What's in their background? Why is there a need for the product? Case studies, testimonials are great. What is your revenue model? What's the size of the market? What will it cost to produce the product or get it to R&D to the phase that is your ultimate goal? And who is your target customer, and how big is your target market? So you'll also want to consider, do you want to do you need to acquire any intellectual property, maybe acquire other competitors in the future? What roles will you fill, or do you want to be the CEO? Do you want to hire in a C-level team? Do you need to hire a head of sales, head of marketing? What are your future features? How much is needed to reach break even? What are your revenue, cost, and profit projections? So put all that in your 10 to 20 slide deck. So homework for this section: if you plan to raise capital, equity capital, you don't really need this if you're doing revenue-based financing, which is why I like it. Create a 10 to 20 slide pitch deck for your company covering the elements recommended in this section. Here's a couple quotes here. Clayton Christensen, a former HBS professor who was there when I was an MBA student at HBS in 2012, 2013, said, if a venture's management can keep returning to the corporate treasury or outside venture capital to fund continual losses, managers can postpone this critical market test and pursue the wrong strategy for a long time. What that means to me is make sure you get to product market fit before you raise outside capital. If you raise outside capital before you get to product market fit, which I define as at least 100K in ARR, ideally $1 million, you're going to have a much lower chance of success, because the second you raise venture capital or even a significant amount of angel capital, you're starting the gun on a track meet, and you're starting to accrue those interest payments. Those are, keep in mind, preferred shares do have interest payments that you have to keep growing the amount that they have each year. As convertible notes have interest levels that you have to keep growing it every single year. And so the second you raise that money, you're in a race. And I think it's much nicer to build companies for the long term that are profitable, that are closely held. That's what we're doing here at SaasRise. We're not raising outside equity capital. We are building it through revenue-based financing and building it for the long term. That said, if you're a high growth company competing in a very competitive market, you may have to grow quickly. We're not in AI. We're not in the fastest growing segments. We're in a community, that has a community platform, a WhatsApp group, a Slack group, and it's really about education, like courses like this and masterminds that we do every week. So we're in a different industry that is a little bit slower growth that goes well with revenue-based financing. You may be in a faster growth industry, but even if you do raise venture capital, make sure you are investing it in a engine that is already built. You can test demand through prototyping. And for B2B companies, make sure you have at least 100K in ARR. These are some of the summary lessons from this section. Now, if you're building a B2C application, make sure you have at least 1,000 monthly active users, if not 10,000 monthly active users before you raise any outside capital. And make sure, as I've mentioned a few times now, don't raise more than 1 times your current ARR. That is one key thing. Lesson take from this is capital efficiency. So if your current ARR is 500K, you can raise up to 500K in equity capital or 250K in debt capital through revenue-based financing. So you want to avoid raising too much, because if your expenses get above your revenue, then your company's going to go bankrupt and your company dies a painful death. And I've been there. I've been through it myself as a CEO at Connect.com. It's not fun. It is way more fun to build iContact and make everybody, all your friends, money than to build a Connect.com and lose your friends' money. It's just not nearly as fun. So that is why I'm building SaasRise as a bootstrapped, high-growth, profitable company where we're focused on EBITDA rather than eyeballs. So to avoid bankruptcy, it's very simple. Make sure your monthly revenue exceeds your monthly expenses. That's it. That's the key. And keep in mind, 99% of firms never raise angel capital or venture capital. And even probably 95% of software firms don't raise angel capital or venture capital. So if it's not for you, that is okay. So your homework for this section, if you do want to go ahead and prepare to raise seed funding or angel funding, and you're ready to go, build your deck and then reach out to a few dozen angels using LeadLoft or FounderSuite. You can reach out to people who went to the same school as you, used to work at similar companies, people you've met in your career. Find that anchor angel and then reach out to everybody to fill out the round. Thanks for listening to this section on angel capital. In the next video, we're going to talk about institutional capital, venture capital. The difference being angel capital is from individual investors, whereas venture capital is from funds, companies that are professionally managed that pool lots of people's monies together, from pension funds, from very, very large sources of capital. And they often have much more restrictive and onerous terms that you have to navigate properly. So if you're ready to raise that Series A, Series B, or beyond, make sure you listen to the next lesson on venture capital. And I am available as a CEO consultant for SaaS companies for either preparing for venture capital rounds or preparing to exit. Reach out to me at Ryan@SaasRise.com if I can be of support to you. Lots of love from Austin, Texas. We'll see you in the next lesson.